Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I'm going to go over oil just because I really do like oil. I think the supply-demand imbalance is quite great. I'm going to go over a couple of things. I'm going to go over one comment first that I know a lot of people have worries about, and then I'm going to go into a bunch of oil things. I've got Gareth Soloway's chart that he thinks why oil is going to go down. I'm going to have a bunch of information that's going to contradict that. We could have a small pullback. They are releasing oil from the Strategic Petroleum Reserve. They are declining. We're eating through our inventories, our strategic inventories worldwide. And inventory, in my opinion, is the balance between supply and demand. And if you're eating through your inventories, you can't have a long-term decline in price because your inventory will deplete and go away. So, in my opinion, looking at the deficits that we are running and coming up into a summer driving season where typically the demand goes higher, where your deficits are going to grow, not contract, we need far higher prices to destroy demand. We don't have the supply. I'm going to go over some OPEC information as well. I think they're tapped out, guys, and that's why they won't raise production because they can't. That's why they're going to say we're going to stick to this plan because they can't raise it. They're done. So let's go into it. I'll give you my opinion as I go along. So here is the. There we go. It says this is one concern that people have. It says I see the yield curve inversion leading to recession, ramping mortgage interest rates, the housing tremors in China. Those are major headwinds ahead. Starting to ask myself a lot of questions about the commodity bull market thesis. No, this is the exact thing that is the prelude to a commodity bull market. This is the outcomes of inflation and higher commodity prices. Higher commodity prices leads to inflation. Inflation leads to higher interest rates and usually inverted yield curves. Now, the question should not be, I see that the yield curve is inverting. The question should be, how high can the yield curve get in terms of percentage? You can go up to, we're at 27%. We should be going above 75%. We have a long way to get this thing inverted. And this is usually what happens before a major move in gold, a major move in oil, a major move in uranium, if you look at history. So these are actually all of the signs and traits of a commodity bull market coming from an inflationary liquidity event of a declining dollar. Now, if China has problems and all of these other countries have problems before the United States in their housing markets, it means that the relative value of those currencies will go up in relationship to our currency. That is why I think the dollar will go down. The dollar, I think, in my opinion, will go down because the housing growth and the new housing's being built in other countries will slow down, lowering their inflation rate while ours is going to ramp up. Now, I want to make this clear as well in the housing market. The housing market, in my opinion, can't materially go down because we don't have the supply. Having prices go up doesn't fix your supply-demand problem. It may the prices may come up to a certain point and slow down. I just want to know, how can something go down, even though the prices are unaffordable in comparison to previous markets? How can it go down with no inventory? That's what you have to solve. That's the question you have to answer. How does an asset or how does a commodity go down when you have no inventory? That either means that the prices are too low because you have no inventory, everybody's buying it up, or you have to increase the supply of that thing to bring that inventory in. And if we have supply chain problems where we are not increasing the inventory at a fast enough pace for how many people want to buy homes, well, then the price is just going to remain elevated. That's my take on it. It is that simple. So watch your inventories. And that's what I'm going to do here. I'm going to watch inventories of oil. Inventories are the rule all of everything. Because if your inventory is going up like it was in 2008, In 2006 and 7, inventory was skyrocketing of homes. It was skyrocketing. And all of this stuff was brought on by more liquidity in the system. We have more liquidity in the system. More liquidity came from the housing market. That is how liquidity gets into the system unless they inject it directly to people, which they're talking about for oil. And I've got a couple examples of that. Let's inject more liquidity and give people money to buy the very thing that we are short. That makes no sense. I'm sorry. That just doesn't make logical sense. But let's get in here, guys. I'm gonna rip it. So here we go. Eric Nuttall, an SPR release does nothing to combat the forces of a multi-year oil bull market. Structural, and that's what I always go back to, structural supply growth challenges and durable demand growth. It's a Band-Aid for a hemorrhage. Short-term blunt, still $100-ish floor, and takes 150 plus second half 2022 off the table. Medium term, very bullish. Only one fix with the US SPR to be at compliance minimums. OPEC spare capacity is exhausted. Enduring structural growth challenges and now potential multi-year decline in Russian production when global oil demand is set to grow for 10 plus years, a much higher price over time. I completely agree. It's that simple, guys. They mean well, but eventually you can't live in la-la land. But a funny thing happened on the bridge to a low-carbon energy future. The fear of peak demand is leading to the reality of peak supply. That's the top energy fund manager says to ride out the oil spike in Canada. Here's Josh Young. We've got Oxy Petroleum, favorite of generalists, disliked by energy-focused investors. 40% increase in CapEx for less production. Oxy, U.S. upstream CapEx grew by 46%, and their production declined by 1%. So we're seeing increase in costs and declines in production of some of these areas. That's why I choose the small cap companies that can increase production of oil and natural gas, and I'm staying away from the big boys because of this. They can't raise production. They're going to spend a lot more money for a lot less oil. It's called peak oil. That's what it's called for the majority of these companies. Goldman Sachs raising their oil price target on failed SPR energy policy. Goldman hikes 2023 Brent oil forecast to 115 from 110 on delayed market rebalancing due to artificial pre-midterm election supply from SPR. Another one. Pelosi says gasoline rebates to consumers among ideas being discussed as alternative to suspending federal gasoline tax. Go Pelosi. Great idea. Coming on up, we've got the crude oil inventory deficit that continues to go down. Gareth Soloway, I did listen to his presentation or his interview, I should say. His interview, he said, we've got demand destruction. Well, no, we don't. We don't have demand destruction. This is going down faster than any time in history, I think. We are continuing to deplete our inventory levels. Why do you think Biden's releasing from the Strategic Petroleum Reserve? If we had demand destruction and we were adding to the inventory, which we're not, we are actually drawing at faster paces than ever before, then we would see oil prices go down. But they're not. They're not going down, and the deficits are getting worse. We are struggling to produce oil, and we don't have an alternative at this time to go massively, we'll say, into electric vehicles. And I'd love to see what happens. I think they actually stopped building the Cybertruck because it became too expensive and the materials were getting too tough to obtain. This is going to impact the future. Anything that is already built that has minerals and energy sunk into it are going to become far more valuable in the future. You can quote me on that. You can quote me on that. If energy gets incredibly expensive, you're going to see existing cars, existing things all go up in value, or in price, I should say. Chicago moves to a program unveiled at a City Hall news conference will make Chicago the first and largest major city in the country with such an assistance plan. So they're coming out with this assistance plan. In a news release, the city said it would provide $12.5 million in relief funding. Of that, $7.5 million would be for $150 prepaid cards that can be used at local Chicago gas stations, and $5 million would go towards $50 prepaid cards that can be used on public transit. Application for Chicago Moves will open April 27th. So we are going to give people money to buy the very thing that we are running out of. This doesn't make any sense, guys. I don't understand this. So they're going to give people money to buy gas when gas is short. That just means you're going to drive the price of gas, the price of oil and gasoline even higher. That's my take. And then looking at total returns after inflation. I always talk about energy being a very good hedge to inflation. This was from 71 to 81. Energy stocks were the spot to be for total returns. You can see treasuries were a horrible spot. S&P 500 was not good. Corporates, utilities, T-bills, REITs, and energy stocks is where you want to be. And that's where I'm at. I'm at energy, nuclear, oil and gas, and some other areas in terms of shipping and metals and stuff, precious metals. Here's one. It says, first quarter 2022 EIA data shows largest quarter one total stocks draw since at least 12 at minus 73 million barrels of oil equivalent, or minus 0.81 million barrels per day. WTI fair value price sits at 120, or $16 undervalued from current levels. Let me read that again. They are saying, given the stocks that we are drawing, that oil is undervalued by $16. Now it's $20. They think it should be at $120 given historical price levels and how fast we're drawing down inventories. The SPR release is accounted for in this analysis, and shift in strategy will have no impact on this calculation. We are in this green area over here in the undervalued section, given the total petroleum stocks. We should be here in the red area of about 120. So if we're at minus here, we should be at 120 for the fair value. Overvalued would be up here at about 130, 140. So we should be at about $120 a barrel, given where we are in the total inventory levels based off history. Coming up here, it says OPEC out of spare capacity, price up, exports down. OPEC crude oil exports during the first 27 days in March averaged 21 million barrels, down 363,000 barrels per day versus the full month of February. Middle Eastern exports down by 16,000 barrels a day. African exports down by 346,000 barrels per day versus the full month of February. Looking at this, it says OPEC won't save the markets this time. OPEC Plus has less spare capacity than claimed after years of underinvestment, and there's little chance it can quell rising prices. This is Bison. I'm not going to go through here, but the OPEC Plus deviation from output targets in 2021, they're all negative. They are underproducing. They don't have the oil to produce, guys. They're hitting peak oil. That's kind of my guess. So it says, historically, SPR releases have temporarily sent oil prices lower and are then followed by higher prices as the market prices in insufficient supply. So this is actually bullish. One, it gives us a buying opportunity. Two, they go higher after it. Here's the U.S. Strategic Petroleum Reserve in number of thousands of barrels. We are declining as we eat through our Strategic Petroleum Reserve. So that's interesting. President Biden announced Thursday that the U.S. would release up to 180 million barrels of oil from a strategic reserve to counteract the economic impact of Russia's invasion of Ukraine. Too bad that doesn't solve the supply problem. We are all paying too much at the pump as big oil exploits the global situation to maximize profits. The decision to lower gas prices by releasing 1 million barrels per oil per day from the strategic reserve is the right call, in this guy's opinion. And then moving up, this is what this was Gareth Soloway and his chart. What he did is he took this as the bottom and projected it up here. Now, here's the thing. This line here, he put up here, and he says, oh, we're going to hit this, and we're going to come lower. The problem is that he doesn't take into account is he thinks that this is free markets hitting this and making this this area here a top. It's not. This is a Strategic Petroleum Reserve release that will temporarily bring this down, creating a large cup and handle pattern, which will dip down probably to about 100, and then we'll break out of this pattern to the upside, going to much much higher levels. We could even see a number with a 2 or a 3 in the front of it. It's possible. But I don't think he's taking into account the information that I just went. That is a false top there. It's going to be a release of the Strategic Petroleum Reserve, some news release. We'll pull on back. It could go to 85. He says 75. If we hit 75, that is going to be the buy of a lifetime. It literally will be. If we were to get down there in the short term, it won't stay down there. I think a lot of these guys think that the 2008 crash is like this. We don't have a 2008 crash setup. We had increasing inventory of homes. We hit 10 months of inventory of homes. Right now, we're at the lowest inventory levels, I think, of ever, of homes. So the inflation driver is still intact. In 2006 and 7, that's when the inflation driver went away completely. You get about 2 years of heads up in advance of that data, of the inventory going up, of house prices leveling off, of foreclosures going up. We don't have any of that. We don't have foreclosures. We don't have inventories going up. We don't have that right now. So I don't see the market conditions for oil prices to remain lower, even though they are releasing from the Strategic Petroleum Reserve. I just don't see that materially lasting. So I view it as a buying opportunity. I think all of the market conditions are still intact. I think that the inverted yield curve does not necessarily matter at this time. I think it will get worse. I think it will last for a good period of time. And then we may have to worry 2-3 years down the road. That is when I think it might matter. Now, here's the thing. Between now and 2 years, we could see oil go to $300 a barrel. We could see it go to some ridiculous level. It's not going to stay up there forever, but it will remain very elevated if we get that spike. And we'll see what happens. I think that with the inventories declining like we are, with summer coming up and summer driving season, with people getting money to specifically buy gasoline, this doesn't make sense to me, guys. We're going to eat through inventory quite quick. We're going to get to critical levels, and then we're probably going to see inventory levels at the lowest spot they've ever been. And that's going to move prices far higher. And we've got the inflation coming into the system as well. This is inflation is the amount of money in the system. It's still driving. So I don't see where the relief's going to come from. I don't think we're going to have a 2008 crash because of the housing market and where it's at. That was a housing market crash. Those are the blowout crashes that we have. We have the demographics to support higher home prices. We have inventories that are incredibly low, and we have oil that is getting eaten up, their inventory, leading to higher prices. That's what I see in the short term to medium term. And we could see far higher prices depending on where inventory levels go. And if we continue to subsidize people with money to buy oil and gasoline, however you want to say it, gasoline, I just see that as a driver to push the prices even higher. So that's where I'm at. Give me a thumbs up if you guys like the content. Subscribe to the channel if you haven't already. Check out my website below. Become a platinum member. Do weekly meetings. Ask questions. Become a better investor. That's where it's all at. That's what we're all here trying to do, is become better investors. And this is what I've got for today, guys. So we'll catch you next time. This is Finding Value.